want to jump straight into our program for the day. And it gives me great pleasure and honor to invite the Deputy Governor of the Central Bank of Kenya, Mrs. Sheila Mijue. Deputy Governor.
I think it's a bit obvious that these podiums were built when it was only men who stood up to speak to an audience. I feel like I'm a bit overwhelmed. Anyway, good morning everyone, and thank you for coming. I want to acknowledge the presence of the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge, Director General KNBS, and the CEO of FSD, Capital Markets Authority. Thank you very much for coming. Development partners present, representatives of media houses, ladies and gentlemen. I want to start by thanking our Governor for his leadership during this entire process. This report comes out every 2 years, and every time it comes out, it adds a huge amount of data that enable us to make proper policy decisions and to move in the right direction in how we're going to address the economy, and particularly the MSMEs and their development as we move forward. In doing this report, we've had great stakeholders. The KNBS has been very prominent in this. The Financial Sector Deepening and Kenya Alliance for Financial Inclusion, on whose board I sit internationally, have also been very present in preparing this. And we must remember as well that we prepared this presentation during a pandemic, so it's been a difficult a difficult report to come out with. I want to also thank all the guests that are attending today and those following online, because the importance of digital currency cannot be over explained. What we're saying is, as we move into the future, what is the impact of this on economies, and not just on the Kenyan economy? I think if you're looking in Tanzania, if you're looking in South Africa, if you're looking in Nigeria, all the examples are different. And we have to try and understand what is happening with these different examples, and what should we emulate and improve, and what should we mitigate and reduce. Measuring access to financial services enables us to see the impact of technology innovations, changing consumer behavior, and demographic dynamics, the impact of policy, and identify the role of new players in this financial sector. So we really need to be looking at this more and more. When we look at Kenya today, I remember when we first released this report about 15 years ago, 10, 15 years ago, Kenya had 27% financial inclusion. And I think when we're talking today, we're 83%. But we still need to ask ourselves more questions about this. It's not as simple. So to the policymakers, the researchers, the development partners, the private sector, and even academics, I'd ask you to delve in some of the questions I'm asking today. And there's probably more pertinent questions that also need to be considered. I've just come up with a few that came into my thoughts. Are people truly financially included? Or have we provided them with a payment system? And when we talk about this financial inclusion, at what stage do you move from one step to another step? For example, if I'm able to get digital loans, which are short-term loans at a higher interest rate, when can I move from that to now having a more stable business by having a longer-term loan, maybe a bigger loan? And so we have to ask ourselves, does digital currency inhibit? Does it inhibit? Certainly it's promoted this huge change from 27% to 83% financial inclusion. But is it now inhibiting the next step? So that's one of the questions. The other one is that we talk about MSMEs struggling to get initial capital and operating capital. And last week or the week before, I was talking to a group of 100 women who are in that MSME category. And they were talking post-COVID. When I say post-COVID, they were talking to me in what they believe will be the period after COVID. And what they were saying is that a lot of you guys, meaning me, think that we need a lot of money. We don't. What we need is a certain amount of money a lot of the time. So they said, if you give us 35,000 and we're able to buy a bigger machine, processing machine, if they're making juices, for example, then you've really helped our business. So we don't need that million. We don't need the 2 million. We don't need the 5 million. And obviously there's a group of people who do need that. But when we're talking about the MSMEs and we're talking about the smaller size, what they're saying they need is smaller money, but regular. Regular and dependable. Regular and dependable. Have we been monitoring what's happening in this sector? And because I work a lot with the governor of the central bank, I know it causes him a lot of sleepless nights. Cybercrime, betting. What are the negativities that are coming out of this new system of ours? And you know, when you talk about betting, and if I say it's not good, that's a judgmental decision. That's a judgmental decision. What I think is betting should be left to adults, and we shouldn't allow children to get involved, just as alcohol is for adults. Yes? So in what way are we going to set policy, and what way are we going to moderate, or what way are we going to lean on this? The cost of accessing and using financial services, and I use this word very carefully, is it fair? People say it's expensive, but again, go and talk to those women, and they'll tell you that they can't get capital. This capital they can get, and they can pay the interest. Can you please stop bothering them? So the issue is fair. What is fair? And we have to understand that, because as regulators, of course, our job is public good. How and why do we address transparency and connectivity? For example, now we're going into Christmas. Maybe you have a small business and you're relying on this mobile money structure to help you with your sales during the Christmas period. What if it all disconnects? Who's to blame? Who's making sure that that doesn't happen? And finally, are there counties that are not getting the same level of inclusion as and others? And what is the social impact of that? So I haven't really come to you with any answers. I've come to you with a lot of questions. I believe personally that what we've introduced in Kenya and how we've modernized our financial system has been the most, or one of the most incredible transformations in Kenya since independence. And I'm a big believer in that. But what I'm asking is, going forward, do we really understand what it's doing? And are we guiding and directing it in the correct way? I thank you for listening to me. Thank you very much indeed.
Thank you very much, Madam Deputy Governor, for those questions. You have set the stage. At least we have stuff to think about. So our next part of the program, we launch now into the presentations. We will begin with Professor Robert Mudida, who is a Director, Research Department at the Central Bank, and he will be taking us through the key findings of the 2021 FinAccess Household Survey. Welcome, sir.
Good morning, Governor, Deputy Governor, CEO of FSD, Director General of KNBS, distinguished ladies and gentlemen. It's a great pleasure to be here this morning and to be able to share with you the findings of this very exciting survey. And it has some very interesting insights and fascinating nuances, which we're going to share over the next few minutes. So the 2021 FinAccess Survey, which is the one of which we're presenting the findings today, is let's say, the culmination of quite a number of surveys, the first one being in 2006. That's when we did the baseline survey. and we've had several editions since then, roughly every 2 to 3 years. This year's survey was carried out between the months of June and September, and it's a cross-sectional survey. This year's survey is also unique in a number of ways. Firstly, it's the first time that the survey was carried out across all the 47 counties. This has never happened before. Also, as we know, in March last year, we reported our first case of COVID-19. And so this year, the pandemic has still been ongoing. So the survey is also unique because the results reflect some of the impact of the COVID-19 pandemic, particularly at household level. And that provides some very interesting insights. In addition, this year's survey is also unique because unlike previous surveys that focused a lot on the dimension of access, this year there's been additional emphasis on the elements of usage, quality, and impact, which gives some very, very interesting and refined nuances about the different areas that are very, very critical. So when we talk about access, we're talking about uptake of financial services. When we talk about usage, we're talking about regularity, frequency, duration. When you talk about quality, we're talking about ability to meet needs, also diversity of different financial services. And then also we look at a very, very interesting dimension which is of great relevance in the COVID-19 era, and that's impact on livelihood. So the issue of ability to meet life needs, impact on livelihood, which is very, very critical. This particular survey targeted individuals who are 16 and above and living within conventional households in Kenya. By conventional, according to the KNBS understanding, you're talking about households that are not refugee households or IDPs or street families. That's the meaning of conventional in that sense. And then there are about 1,700 enumeration areas that were selected across the different counties. So in a sense, the survey is a result of stratified random sampling, but within each household that was selected and interviewed, then interviewees were selected randomly. So the study used 50 different domains in that sense. First, there was the national domain. Then there was the rural domain. Then the urban domain. As you'll see when we present the findings in more detail, this distinction is quite important because you see quite a number of interesting differences between rural and urban areas, and then the 47 counties themselves. Eventually, we used a sample of 30,600 households, which were based on a KNBS Kenya Household Master Sample, which in turn was based on the 2019 Kenya Population and Housing Census data. So very, very current in many respects. And out of that, the overall response rate was impressive. It was a response rate of 85.6%. In terms of some basic survey demographics, you find that if you look at selected households, remember the households are selected based on this master household survey of the Kenya National Bureau of Statistics. You find that a larger number of households that were selected were in rural areas compared to urban areas. That's not surprising because the majority of Kenyans still live in rural areas. And in fact, you'll find that the eligible households and ultimately the households that were interviewed reflect this balance, broad countrywide balance between rural and urban areas. So you find the response rate was slightly higher
in rural areas at 88.6%, slightly lower in urban areas at 80.5%, because in these surveys you always have a number of people who refuse to respond. Okay, so you always have a non-response rate, and that's normal. Then in terms of the survey demographics, you see a very good balance here between male and female, with the females who responded being, of the total number of people who responded, 51.5% were female and 48.5% were male. So very good balance there in terms of responses according to gender. Then population by residence was about 63.5% from the rural areas, about 36.5% from the urban areas. Once again, not surprising, because that roughly reflects the residence of Kenyans in rural and urban areas within the Kenyan population. The study utilized the latest technology, which is called computer-aided personal interview, which is a system used for interviews whereby once you go into a household, you also have your tablet there. As the questions are being answered, you're relaying in real time these particular results to a server. So the latest technology used there, but at the same time, you're face-to-face with the person who you're interviewing. More refinement was obtained in the survey by having translations into several local languages to aid comprehension of the survey. Swahili, which is the national language and is widely spoken, was the most preferred interview language for most people. After the survey data was collected, KNBS cleaned the data, weighted the data to the total population, just to ensure, the main idea of that being to ensure that the sample was representative and adequately representative of those aged 16 years and above. So that is a bit of background in terms of the methodology. Very, very robust, detailed methodology applied to this particular survey. And now we go into the specific findings along the 4 dimensions that I talked about. And as I reiterated, this year there was a lot more insight and a lot more detail provided on the other dimensions other than simply access, which had been a major point of emphasis in previous surveys. So if you're interested in the dynamics surrounding ordinary Kenyan households and how they interact with different financial products, you get very exciting insights here. So the first highlight of the study, and with you have, in addition to the detailed report, you also have highlights, a couple of pages of highlights. So the first big highlight, and this is always the most awaited number, was that access to formal financial service providers rose to 83.7% in 2021, up from 82.9% in 2019. And by formal, we're focusing then on the ones that are registered. Informal, we're talking about non-registered financial service providers. And an interesting finding also that's quite insightful is that those accessing informal providers declined further. So this amount of those accessing informal providers has actually been declining over time. And that's an important finding because it means that people prefer formal financial services which are better regulated, which are more stable, and which create less uncertainty for them in different respects. One highlight that was a little bit on the negative side was the fact that the excluded population rose compared to 2019. So the people who are not covered by financial services cannot access either formal or informal and utilize, for example, social networks to be able to meet their day-to-day needs. So this is an excluded population, so this number rose slightly to 11.6% in 2021. An important reason for that could be what I mentioned earlier about the fact that this survey was carried out during a pandemic and the impacts of the pandemic was still being felt. and this constrains certain aspects because of some of the lockdown restrictions associated with the pandemic. It was more difficult for some of the youthful population, for example, to get national IDs. So that reflects some of those dynamics associated with the COVID-19 pandemic. The most excluded categories, as you'll see, were elderly, above 55, and also the youthful population. So that's what you see. So you see an increase in, when you look at the access trends, since the first survey in 2006, if you look at that graph there, we economists love graphs, okay? So you know, but when you understand economics a bit better, you realize that we're actually more interested in the shapes of the graphs, not only the graphs, okay? So you can see the shape there. You can see some rapid increase in access during the earlier surveys, for example, 2006, 2009. And then from 2013, you see a slowing down. And now you can see a sort of plateauing to some degree, okay, of this access. So that itself, that's almost a natural phenomenon, okay, because it reflects that there's already been considerable uptake, and so the scope for much more uptake probably is limited, all right? Then you have access by categories here as well. You still find there's quite important dominance by the category we call formal prudential, which is financial service providers who are prudentially regulated by an autonomous institution such as the central bank, but also Insurance Regulatory Authority, SASRA, and so on. So there you find, that's what we classify as formal prudential, and then you have formal non-prudential, which are non-prudentially regulated, but still overseen by some sort of government authority, for example, a ministry. So you have that, that's also quite important here. And then you just have formal registered, all right? And then you have informal sources, which are not registered, all right? And then you have the population that is just excluded, all right? Simply does not have access to these different means and utilize social networks. So overall, if you look overall, you actually see that the number of those who use certain products actually increased compared to 2029, and you actually find this across different categories of products. So when you look across these different categories of products, you see that there's an increase in different types. For example, bank products, mobile bank, insurance, NHIF, NSSF, mobile money, of course, continues to be very important. So broadly, you see an increase there in many of these categories. Then something that's, of course, very interesting for us, also in line with the Deputy Governor's question that she raised about access and about inclusion. So this point was also a point that was taken up with quite some interest in the study. And this is the individuals who are excluded. So those excluded rates by age in 2021. So you find largely, if you look at the percentages, you find those above 55 years and surveyed here, you find an exclusion rate of about 15%. Then when you look at the youth 18 to 25 years, find about 22.5%. And as we mentioned, the exclusion rate was actually up. All right, so some of the factors that explain that, I already talked about the COVID-19 dynamics, which certainly affected the exclusion rate, but also you're talking about liquidity, whether these different groups have liquidity. For example, many of the youth and also the elderly don't have sources of income at certain points in time, so that can be an important factor in exclusion as well. Because utilizing these different services presupposes a certain liquidity as well, which might not be available sometimes to all youth and all elderly people, but of course then also exacerbated by the effects of the COVID-19 pandemic. A very exciting and gratifying finding of this particular survey was that disparity between male and female access reduced. So this is something we were really excited about, because it means that disparity is actually declining. And remember, this was done across 47 counties, so this makes this finding even more exciting given the scope of the study itself. So you find the gap between male and female actually improved, meaning it reduced, okay, to 4.2% from 8.5% in 2016. So this we were very excited about, okay? And of course, the point that I mentioned earlier about the fact that in more recent years, this is the typical economic phenomenon of plateauing out. You see that in the earlier years, for example, if you look at 2009 to 2013, there's a very, very rapid growth in mobile money uptake. Remember, this was a very new product then, okay, and this continued for a number of years. But around 2016, you start seeing some plateauing there, okay, start seeing it going to 9.8%, 8%, and then now 2021. So you can see some plateauing occurring there. But one positive aspect of this is that it means already the uptake is very, very large, and many, many people are substantially covered by this access. Okay, so such that there isn't considerably more scope to be able to increase access. So we can also look at that positively in a certain sense. When we look at this marginal uptick in the exclusion rate, also now going across different factors and going across counties, you find something interesting. One is, of course, the impact of income disparities measured by wealth quintiles. Remember, quintiles is when you divide into 5 different groups, so you have 5 different groups arising there, okay? Percentages of 20% each, so that gives a sense there. So you can find in the highest quintile, okay, top 20%, you actually find the exclusion is very small. It's at 3.6%. And then when you go to the lowest quintile, you find the exclusion is 25%. Not very surprising, because those in the lowest quintile will have less wealth, hence less access to liquidity, and so less access to financial services as well. All right. Then you also find that, again, not very surprisingly, because the urban areas are wealthier, the urban counties generally tend to be wealthier. So also not surprisingly, you find that the exclusion in urban areas is lower at 6.2%, in rural areas actually higher at 14.7%. And then you find very important aspect of age as well, so more exclusion among the elderly greater than 55 years, find 14.9% exclusion, and then among the youth. Remember, the youth were the most adversely affected by the COVID-19 pandemic, okay, because it immediately slowed down job creation. Quite a number of people lost jobs, those coming out of university, and different types of technical colleges found it more difficult to get jobs, so then you find it's harder to get liquidity in that sense. Something also that was very interesting when you look at this study is variation in formal access across counties. So you find Nairobi with the highest access, all right, through formal providers, while West Pokot had the lowest access, but you have more details by counties there. Then also an interesting finding here is that the highest informality as well, so where you're dealing with non-registered providers, was in West Pokot, Turkana, and Samburu, right? So you see some interesting variations across counties there. And then once again, financial inclusion is an exclusion, okay? You can see is influenced quite a bit by the key factors of income disparity, so including income disparities across counties, then age, question of youthful population, elderly population that we alluded to, and then the question of residence. Are you talking about, are you in an urban county? Are you in a rural county? So that has quite important implications as well. We found that the exclusion rates were highest in Garissa, followed by Narok County. So that was an important finding here as well. But you can find what's very interesting about these results is that the results are displayed for all 47 counties. So you can dive deeper into that and see if there are particular counties you're interested in. You can actually dive deeper and you'll be able to find out what the exclusion rates are. So that's the big question of access, which as you know has been a very, very big pillar of these studies. But this year, we made it even more exciting by giving more emphasis to some of the other pillars, okay? Refining the studies as we've gone along. So the next dimension is usage. And usage deals with depth or extent to which financial services and products are used. So you're looking at issues like regularity, frequency, duration of use. So how frequently do people actually use these providers, for how long, what are the reasons for use or non-use. So this is also interesting. And then of course we connect this to demographic indicators like age, gender, education, resident, wealth quintile, county, okay? And of course, what we found is that most people use these financial services as a portfolio. So they don't use one, so they use them as a portfolio. And of course, the portfolios differ, so then they are not additive, all right? So that's an important point to mention as well. So what we find is that mobile money and mobile banking usage, including some of the newer products that have come onto the scene, are actually driving financial inclusion. There's a decline in digital apps. This could reflect the fact that there's more competition from regulated digital credit providers. And as I mentioned, that tends to provide more stability, all right? And some of the unfair debt collection practices that particularly characterize some of the more informal providers, all right? So I think this is an important point, that you're getting a greater formalization in a certain sense, all right? And also, to reinforce that point, we find that usage of all non-bank related providers declined in 2021. All right? So you're finding again, the bank-based providers are considered to provide greater formality, greater stability. They are regulated. So that tends to generate more interest and uptake among different people. So now we're getting into types of quality dimensions, right? At the same time, you see overall, we have increased frequency of mobile money and informal groups usage in 2021. So despite the fact that we talked about a certain plateauing, but still you find this increased frequency of usage, okay? And also informal groups. This, remember again, where the survey is undertaken during the time of a pandemic. So people's needs basically rise, their need for liquidity increases. So during a pandemic, you've suffered certain types of shocks, so you need certain types of liquidity. So that's why you find some of this, an uptick in some of these. But at the same time, also very importantly, government policy to curb the spread of COVID-19 in 2020 was associated with certain measures that aimed to increase the use of mobile money in order to slow down the spread of the pandemic. And also there was a waiver of transaction charges. So in this data, we actually see the positive impact of some of those government policies. We find that when you look at this graph, we find that the majority of Kenyans used financial service providers on a monthly basis, which is also not surprising because you're dealing with salaried employees, you're dealing with remittances to SACCOs and so on. So you find the frequency tends to be monthly, so it's not surprising that monthly tends to dominate. Nevertheless, okay, the daily and weekly usage still increased compared to 2019. And that's an important point because once again it reinforces the fact that liquidity needs of households were going up. Again, remember we're in a period of a pandemic, and that might have had an impact there. Then Kenyans like variety also. That's an important point. And you see that consumers use a portfolio of financial providers, services, and products. And that means that many of the customers get increased utility from a range of providers as opposed to very narrow, sort of restricted basis. So again, this is a quality dimension. People prefer broader variety and range, and you can see that the green part of the graph there actually expanding quite substantially as we move from the 2006 to through the years to the 2021. You can see individuals who use 2 or more types of financial services actually increased in terms of proportions. Then also very, very significant, mobile money, which is one of the great innovations for which Kenya is known globally. When you go to many parts of the world, people are always asking you about Kenya's mobile money innovations and so on, something that actually has given global fame in a certain sense to Kenya. So you find products that are based on that, especially products that are better regulated, more formalized. You find they experience quite an uptick. And very critically for us and very exciting for us is the fact that they continue to drive a narrowing gap between male and female users. Although when you look at informal sources, okay, you still find more females rather than males tended to prefer to use informal sources. But as I mentioned, the gap is narrowing very, very substantially. And what that reflects, a very important point, that there's rapid adoption of digitalization by females as well, which is very, very exciting for us. Some of you must be asking, when you're thinking about this, so what does this mean for traditional banking? Brick and mortar. I like that expression. Okay, so what does this mean for the brick and mortar traditional banking usage? Well, it's continued to decline. And in fact, that's a trend that's been there since 2016, as more people embrace mobile banking across all demographics. So you're talking about greater awareness about mobile banking across different demographics. Okay? And what's very exciting for us as well is that female and rural residents are adopting mobile banking faster because of improved infrastructure as well, like cheaper smartphones, greater convenience. So you see this coming across. All right? In terms of constraints, because when you do a survey like this, you also want to be aware of constraints. You don't only want to tell a positive story and only the positive dimensions. You also want to look at constraints so that one can think about how these issues can be addressed in future. You still find that quite a number of Kenyans still don't have a bank account, and so we dived into the reasons for not using a bank account, and what we found is that a number of individuals just lack money to save. Okay, simply. All right, they don't have regular income, so they associate probably having a bank account with having regular income, some money to save. It costs a certain amount to be able to operate a bank account. So these are the main reasons that people cited for not using a bank account in the last 12 months prior to the survey. So it gave us some understanding about that as well. And then also, remember, these dynamics were probably exacerbated also by the COVID-19 pandemic, because then savings would drop and other important attributes as well. Then we found that also, interestingly, the actual usage of non-bank financial providers services and products, except for insurance, which is regulated by the IRA, declined in 2021. Even NHIF use declined despite recent initiatives, and we attribute that probably as well to the COVID-19 pandemic, related restrictions, the impact that they might have had as well. All right. Then usage of chamas, groups, family, neighbors, and so on, sort of informal, informal, that is not registered or regulated, increased in 2021. And this highlights the continued importance, despite the rise of formal products and services. You still find that many Kenyans across the 47 counties still value social networks. So social networks are still very, very important if we want to achieve financial inclusion. So despite the fact that overall you find access and usage of informal sources, is substantially less than formal sources, but you still find that these continue to be important in some way. And again, remember the pandemic. We're in a pandemic, and so these informal sources would also have supported households during the pandemic. Use of secret hiding places and shopkeepers declined marginally. So this continues to decline. Okay, it's very sort of informal sources. Cash is still, in a certain sense, despite these different products, cash is still very critical for most Kenyans. Okay, so cash is still very critical, followed by mobile money, and they dominate transactions channels in 2021. Okay, and of course they continue to be critically important because many Kenyans use this for daily expenses. They use this for education. You know how important education is for us as Kenyans. It's one of the sectors where ordinary people always want to invest. Even people who are struggling always want to take their children to school if they're able to. So you find that still very, very critical. And then different types. Some sent money within, particularly. You also find some transactions related to receiving money, and so on and so forth. All right. So cash continues to be important. And then the majority of Kenyans still use both cash and non-cash across different types of transactions. So about 80.6% of transactions are still dominated by cash and non-cash. And I think that's very important. And if you dive a little bit deeper into this, I already mentioned we're very excited about the fact that the divergence between male and female has decreased, and actually you see this very much. If you look at cash and non-cash use, you compare male and female, it's just a comparison of male 81.59, female 79.66, very, very little divergence there, okay? And if you look at rural, urban, there's still, of course, some divergence, but again, it's not as wide as probably you'd expect it to be. So in urban areas, cash and non-cash at 86%. In rural areas, you find this at 77.3%. Okay, cash only is used more in rural areas, so you find this at 22%. Urban areas, it's less. You find the cash only is just at 11%. Of course, showing greater uptake, probably because of greater awareness of technological innovation. But what you find is that the gaps are not as wide as one would expect sometimes. And then mobile money is a great equalizer across the counties. And what you find is that a number of counties are basically the most diverse in terms of usage. So you can dive into different counties and look at that, but just to highlight a couple of things. For example, Kirinyaga, Nairobi, and Machakos were the most diverse in terms of usage, right? And mobile money dominates in many different counties, all right? And then you find that At the same time, probably reflecting agricultural activities, small businesses, you still find that there's still quite a bit of informality at the same time in Kirinyaga, Murang'a, Makueni, right? So you find some interesting county trends there. Then you move on to the quality dimension. And our deputy governor talked about the point of quality and the way we needed to get into understanding issues of quality more. So here we're looking at, say, fitness for purpose, if you like. To what extent do the products and needs match clients' needs? How fit are they for the purpose, okay, for which customers require them? Is the range adequate? Are clients aware? Do they understand them? How financially literate are customers? Then that deals with the quality dimension. So one element of this that is interesting is, of course, the area of financial literacy. And you find that in this area, the majority of Kenyans seek financial advice from informal sources, family, friends, personal knowledge, experience. In fact, we found here that 45% of adults still rely on friends and family for financial advice. 43.3% rely on their own knowledge for financial advice. So that says something about the prominence of informal sources in influencing financial literacy. So we did a small test. We gave a small computation. This computation that we're familiar with from long, long ago in our studies. Say, compute a 10% interest on a 10,000 Kenya shillings loan. And then 49.3% of the adult population got the correct answer. 66.3% correctly identified transaction costs on a mobile phone. So it tells you that there's some knowledge about the cost of borrowing, some knowledge about transaction costs. It tells you more people are aware about transaction costs, maybe fewer people are aware about cost of borrowing, so some probably awareness issues there. And then respondents were also knowledgeable and mentioned the issue of unexpected, unclear charges. Okay, so more of them were able to do that. So again, that's telling you about increasing awareness of these unexpected and clear charges. And then other challenges that they cited as well were frequent system downtime, poor customer service, and lost money from the accounts. So an important aspect of this is there's awareness about that, and then you now have a sense of what the main issues were. Then also very important here is the whole question of household indebtedness. We often talk about debt at an aggregate level, so there's often discussion about that, but sometimes it's also interesting to be able to do this at household, micro level, and see what are the dynamics there, all right? And we noticed that debt distress is a major challenge that affected consumers in 2021. Again, not very surprisingly, given the fact that we still have an ongoing pandemic, with about 10.7% of borrowers completely defaulting, all right? And then you have some who paid late, some who paid less. So that whole category of never paid, paid late, paid less, 42.6%, so quite sizable, all right? Those who paid less, now if you break this down, 12.4%, those who missed a payment, 15.6%, those who paid late, 38.2%. So maybe one positive aspect here is that many people tried to pay, so there's a sense that from this data that many paid late and relatively few did not pay at all, okay? So that's still something interesting that comes out of that data. All right, about 14.4% of respondents with existing loans from banks and SACCOs and so on applied for loan restructuring, right? Again, you're thinking here of the pandemic impact, and there were some broader policy measures along these lines as well. So with 77% of them being successful. And then also what you see here is, again, very, very interesting household dynamics, okay, about strategies employed in debt repayment, resolving their indebtedness. So many households didn't just go for other financial products, they actually took other types of measures, okay? Some, non-financial service payment related measures, like for example, cutting down on expenses, food and non-food. They ran down their savings, they looked for additional work, okay? Took another loan to repay. So you can see a lot of dynamism, versatility in the different ways of coping to repay in difficult times. Interesting insights on betting, and betting continues to become less popular. So those who perceive betting as a good source of income actually halved in 2021 compared to 2019. The majority being female respondents who basically contributed to that reduced trend in betting. So people also bet less frequently, and also the amount per bet actually reduced. Okay, so people now becoming more aware of the uncertainty associated with that as a source of income. Then finally, the fourth dimension that we looked at in this survey, again, a very nuanced and very interesting dimension is impact. Okay, so impact here, you're looking at questions of livelihood, and putting food on the table and different types of priorities. So they were concentrating a lot on impact of these financial services and the ability to impact livelihoods, which I think is a very important question. So putting food on the table was then a key priority for Kenyans, not surprisingly, right? And other priorities that were very important in terms of life goals, of course, were education, continue to really value education as Kenyans, improving livelihood sources, career development. So you find other types of issues. Health, you can see, given some priority, but less than these other ones, getting a job and so on. And then you see some food vulnerability. You see quite a bit, if you look at those food vulnerability charts, you see quite a bit of, let's say, increase in food vulnerability. Okay, you see quite a bit of increase in food vulnerability across different categories, right, in 2021. Again, not surprisingly, because we're facing a pandemic. Okay, so you find that the number of respondents who reported financial needs to deal with a shock, so some kind of shock. We know the big one of COVID-19, but also there are other types of shocks that people deal with, all right, actually increased to 67.1% from 36.2% in 2019. Definitely a part of that will be due to the pandemic, but also other types of shocks that they might face. All right, so the financial needs still of individuals continue to be this day-to-day. You still see the day-to-day struggle, people struggling to make ends meet. Then the issue of shocks being experienced, significant proportion of people experiencing shocks. All right, so examples of these shocks more specifically, and you can see them by percentage there in the right chart: major health problems, loss of income, death of a relative, pest diseases. Okay, here I'm talking about some people in agricultural sector as well, and some of the issues that they experience there: theft, violence, death of the main income earner. All right. So you can see this different types of shocks. So you see more of this being reported than was the case in 2019. All right. And then use of formal solutions, informal solutions declining. Okay, in terms of meeting financial needs. So this is a very important attribute and nuance here. Okay, because earlier, of course, the access is increasing, but now we're looking at in terms of meeting these needs. So you see quite some struggle here in terms of these formal and informal solutions able to meet day-to-day needs, meaning that people are turning to other non-financial ways of dealing with some of the day-to-day needs and shocks that probably they are facing. Maybe getting an additional job, all right? And other types of non-financial means. So this is an interesting point because it's a very important nuance when you talk about how well some of these different, basically some of these different financial products and services and the informal ones can deal with these three attributes of meeting day-to-day needs, dealing with shocks, investing. So there's still some challenge there, okay? And again, keep in mind the pandemic environment, because once you're in a pandemic environment, all these things become much more difficult to deal with. So overall, if we look at the Financial Health Index, this declined in 2021 compared to 2019. And what that implies is basically it was much more difficult to meet day-to-day needs, cope with shocks than had previously been the case. But there was still optimism about investing more in the future. So in conclusion, okay, we can say that the 2021 FinAccess Survey provides really a broad range of data and indicators for tracking developments in financial inclusion. Many nuances have been emphasized in this particular survey. Cross-county comparisons that are very interesting have also been brought out here, okay? Overall, one can see, some patterns becoming more entrenched, but some changes as well in consumer behavior. The impact of technological innovation is quite clear as well. The impact of policy changes also is reflected in some of the data that we have here. Demographic dynamics are very, very important in explaining some of the outcomes that we have here. Some new players have entered. Overall, remember the COVID-19 pandemic is a global pandemic, okay? So you can see the impact of globalization and a greater global integration in a certain sense, which is reflected in pandemics spreading much more rapidly than was the case before. You can see that the survey scope was expanded to get very important nuances beyond simply access or uptake, getting into usage more in a more refined way, looking at quality, fitness for purpose, looking at impact on livelihoods, hence providing us with many, many valuable insights. We welcome more in-depth research from the academia, development partners, private sector and policymakers, so that this may guide policy solutions and provide new knowledge and continue to influence innovations that will benefit customers. Thank you.
A big round of applause, not just to Professor Mudida, who very excellently put out the findings of the survey, but you can actually see how much work went into the data collection, the analysis, trying to be able to make sense of what the Kenyans themselves were telling the people who are coming around to ask them questions. Before we go to the next stage, I wanted to do something very small, which is recognize that we have been joined, and we're very honored to be joined by several people who have been joining us as this has been going on. And I'll begin with Dr. Julius Muya, PS from the Treasury. Asante sana. Knowing Dr. Muya, he's very interested in this. I could see him making his own little calculations as the presentations are going on. So PS, take one hat off. I know he's trying to see, is the interventions you're doing back at the Treasury, how much impact are they having? But thank you very much, Dr. Muya, for joining us. We also recognize, and you saw him earlier, this is Wycliffe Shamia, the Chief Executive Officer of the Capital Markets Authority. We also, with Godfrey Kiptum, the CEO of the IRA, obviously insurance playing a very big part, and I think Professor Mudida mentioned that as well, in terms of just the different ways of inclusion. And also a player in the sector, Lydia Kibara, the CEO of Muungano Microfinance Bank. Again, this information that is being shared and the data that is being shared this morning is not just for academic purposes. It actually does go into decisions that are made by different institutions, both at a policy level, but also the ones that are directly interacting with us Kenyans. So that's why you're seeing so much interest. And also you've seen us moving around quite a bit. I hope it wasn't distracting. Part of the reason for that is there's a lot of conversations that we're starting to see online, because as you know, this is being broadcast live, like we said, to the world through the different platforms. So there's a lot of discussion going on there. Some people asking questions, but more interestingly, it's just people starting to analyze the data themselves. I would put in Kiswahili better, wanachambua sasa, wanaangalia yale maneno ambayo tunasema, na maanza kuchambua kujua wa Kenya kwa kweli na wanaangalia haya maneno vipi. So that is something that is of importance, and we encourage you to continue doing so. We shall have an opportunity to put questions, to analyze a bit more. So if you want to do it online, please go ahead, put it on those platforms. You can put it as part of the chat on YouTube or whichever other platform you're doing. We'll be able to grab them from there. Now, Professor Mudida did break down quite a bit in terms of the data, and you must understand the number of dimensions that this data has is, and I hope I'm not exaggerating here, I'm not an economist, but it's possibly hundreds of different dimensions. I can see economists laughing at me. And I'll tell you why Rajab particularly is very amused. The thing is that we can literally sit here for 3 days, 24 hours a day, and not be able to go into every little detail of this data. So what Professor Mudida has simply done is given you the highlights. But there's something very interesting that we've done this year. We did it in 2019 as well, but to a smaller degree. This year in a lot more detail, and that's what I want to invite Rajab here to do, which is what we're calling data visualization. And without stealing the thunder from Rajab, what this is simply you who's sitting there going onto the website, going in and actually analyzing this for yourself. So for instance, for me, and I remember I was doing this when they finally finished the data collection and analysis, I said, all I'm interested in myself is data from over 40-year-olds in Nairobi. That's the only data I'm interested in myself, because I'm one of them. I didn't want to know anything else. So please give me that particular dimension of this data. Everything else is for other people. I wanted to know where my group is represented. Someone else will come and say, I'd like to know what the data dimensions are, for example, for women who have a certain age group in a certain county, etc., and so on and so forth. And Rajab, that's why he was so amused when I started saying this, because a lot more breakdown of this data. And I actually want to invite him now to please come up here to just give you a bit of a sampling of this. And after that, we'll encourage you yourself to actually go in, and you'll do this literally until Christmas and beyond, to now do this data analysis for yourself of the dimensions that are of interest to you. And this is actually one of the more exciting parts of this. So Rajab, as soon as you set up your laptop properly, please go ahead.
Thank you, Alice. The PS, Treasury, Governor, Central Bank of Kenya, CEO, FSD Kenya. Sorry, I think I'm losing my connection. Yes, back. Yeah. Director General, Kenya National Bureau of Statistics, invited guests, those following us online. Actually, maybe just to summarize that, Wallace has already stolen my show, but I'll make sure I correct the situation and I'll steal it back. So by the end of my presentation, please acknowledge if I've stolen it back. Kenya National Bureau of Statistics has introduced a way to disseminate data in a better manner, so that the researchers outside there who are now trying to analyze this data can actually dig deeper and delve into it. So I'm now presenting the Kenya National Bureau of Statistics website. In this particular website, the URL is www.knbs.or.ke. If you scroll down, you'll be able to see the data sharing platforms. So these data sharing platforms is where we are trying to share with you data, and we have got several of them. So we have like the Kenya data portal, we have the Canada portal, NIPFIN, but of interest for us, so you'll see this particular page. This is the page where you'll be able to access the data from the 2021 FinAccess Household Survey, and of course the prior surveys that have been there. So from the presentation that Professor Mudida did, you can actually download this particular report at this particular point here, because I know we are trying to discourage printing of many of these reports. So we have put it already online. You'll be able to get there. On this homepage, you will see just a few definitions of the major highlights, I mean the chapters that we have in that report, one of them being access, which tells you that you are trying now to capture individuals with their active accounts in their own names and in the last 12 months. You could also see usage, the definitions there. We have also made a few dashboards. For access, we have two of them, one that comprises access and also access by service type. For usage, you can see several of them. We have got usage by savings and deposits, usage by credit, usage by bank products, usage by, transactions and payment methods, usage by insurance. When you go down to quality, you'll also see several dashboards. We have got a dashboard on gambling, a dashboard on financial literacy, a dashboard on service provider challenges, debt stress, and also on impact. We have got financial health, financial components, health components, financial needs, perception status, life priorities. Still on the left, you can see methodology, and also some of the reports and data sets that we have actually uploaded. I'll take you quickly to access, just to show you how you can interact with this data. Also, again, we've put a few definitions there about when you talk about formal. Formal is actually divided into formal prudential, formal and prudential, formal registered. We also have the informal and the excluded. And now here we have dashboards, reports, just the same way like Professor Mudida gave to us. But now here, you will be able to interact with them in various ways. So at the top here, you can see some menus again. Sex, residence, livelihood, education, wealth, age. And on the right here, you can see years. So like right now, I'm displaying data for 3 years, 2016, 2019, 2021. If you wanted just to compare maybe 2 years, just untick, let's say 2016, and then the graph will come out for now only 2 years. It will give you just for 2 years. Now, like you can see, we are only now displaying for 2 years. So you can compare for 2 years. You can disaggregate data, like you see this chart here. Right now it's showing the total. But let's say if I wanted to disaggregate it in terms of male, female, I would come and maybe create on click on sex, and then it will be able to actually disaggregate, and then I can now view the data in terms of male and also female. Again, you can actually download this if you wanted to download other particular type, so that you can view it, maybe use it for different purposes. Yeah. So that is the kind of data that you'll be able to see, and of course there will be so many other charts that you'll be able to get on your working. some of this data has not all been completed. So let's say if you clicked on gender gaps, you're still working on this. We have given you an opportunity as a user outside there to be able to actually give to us your details so that immediately this data comes on. And not maybe just the gender only, but any other data that you want us to give to you, you can actually put your details at the organization, and then you send to us your email and then submit this. Then we'll be able to actually, later on when this is ready, we'll be able to give it back to you. So I think I just wanted to use those few minutes to show you the platform that we are using. And with that, you are free to interact with this data as much as you can. Thank you so much.
Rajab is perfectly capable of creating his own sunshine. So I stole no sunshine and no thunder whatsoever. It's actually really, really exciting. I'm not just saying that because I'm standing up here. This is one of the first opportunities, especially for data that is this level of complex and this amount, for you, the user, to actually be able to pick out. And for me, wearing the hat that I wear sometimes, which is someone who's trying to put out information to the world, if you're a journalist, for instance, and thinking about the findings from this launch today, your headline this afternoon, this evening, into tomorrow's newspapers, you could obviously just go for the big number. What is the state of financial inclusion at the aggregate level? This is the number that Professor Mudida spoke about first. But you can imagine if you're able to then go down into the more disaggregated data, like we're saying, for almost any dimension that you can imagine. There's so many stories that you're able to put out from there that actually do tell interesting narratives about where we are as a country when it comes to financial inclusion. So again, just as a reminder, go to the KNBS website, the Kenya National Bureau of Statistics, knbs.or.ke. There's a link for FinAccess there. We shall also give you a link from the FSD website and also from the Central Bank of Kenya website. It will all lead to the same place, and from there you're able to play around with those numbers and create even graphics that you're able to download, whether you want them as JPEGs, PDFs, whatever it is. They'll be able to do almost magic. So we are at the stage where, before we call our principals to come and address us, there must be a number of issues that have come up, and so we encourage you at this stage, if you have any questions, you could please put your hand up. We have microphones that are here in case there's a question you want to ask. And as we are getting that, and there's a whole panel here waiting eagerly to take your questions. There's already some that have come. And one question is, what's the role of mobile application fatigue? Interesting. What's the role of mobile application fatigue on the decline of digital apps? I believe Professor Murida actually did point that out in his presentation. Then this must be an economist. What is the margin of error from the survey? So this is a governor's statistical things right in there, which I know nothing about. So what's a margin of error? Someone wants to have it to the last decimal point, like a Formula One race, to the last thousandths of a percentage point. So I guess our very able team, Professor Modida, Dr. Amrik Hare, you can answer those two questions, the role of mobile application fatigue and the margin of error from the survey. And the rest of us in the room, in case of any questions, please prepare them. And you're free to put your hands up to place those to the panel. So Katush, if you can get a microphone to our distinguished panel here, they can take those first two questions.
Who do we start with?
Amrik, so she can tell us about, I don't know, margins of errors and things like that.
Margin of error, I'm going to hand to my colleagues from the KNBS.
Okay, thank you. About margin of error, it was about 3%. Now we are talking of 95% confidence level. Thank you.
Okay, I don't know what he said, but he made sense.
Let me remove my
Mask.
mask.
Yes.
I'm saying that about the margin of error, it is about 3%. And generally, we are talking of 95% confidence level. So that margin of error, it is acceptable standard, or it's at the acceptable level.
Thank you. Thank you very much, Atwasi. Rick, the question of, or Prof, the question of the role of mobile application fatigue.
Yeah, thanks a lot for that.
Prof, just hold it slightly closer so you can get the sound. Yeah, thanks.
Okay, thanks a lot for that. So just the insights from me would be, first of all, that yes, you can see that to some degree, just as we mentioned, that you can see some diminishing returns, you can see some plateauing of mobile applications uptake, and definitely that could be partly as a result of fatigue. But at the same time, I'd point out a couple of nuances here, and one is that certainly this is not only determined by fatigue, or is not simply an issue of fatigue, because you still have some exclusion. So the fact that you have some exclusion means that there are reasons other than fatigue that explain why probably mobile applications are not being taken up. So we talked about the demographics of the youth and also the elderly. So that's just, it's not simply an issue of fatigue. The issues of liquidity, for example. So I think that comes up. And remember this, the other nuance on the last dimension of impact, we're looking at ability of financial solutions to deal with livelihood challenges and meeting day-to-day needs. And there you see some issues still. So the mobile apps, despite their innovation, still do not completely meet these life needs, sometimes leading people to resort to other aspects. So there is an element of fatigue, but there are also other drivers. Amrik will add to this.
I'm just going to speak directly from the data, which is that the reasons given by people for not using digital apps were outstanding debt and credit listing. So I think especially in COVID, there was quite a lot of pressure obviously put on people's ability to repay loans, and that may have also induced lenders to reduce their lending portfolios as well. So I think that the lack of uptake of digital credit apps probably came from both a supply-side dynamic and a demand-side dynamic.
Okay, so two more. I'll just pick out two more before I come into the room. Dr. Moses Mudhinja, he sounds more like a comment. So he says the increase in formal, maybe as a result of ease of access, but not because of preference for regulated providers. And he goes on to add, I think it just happens that the regulated providers have the technology to provide the loans and the funds to lend. Mark Kimondo asks, what to make of the rapid increase in the formal non-prudential from 2016? Is it in terms of credit only, i.e. digital platforms, or is it savings/insurance? Did you get that? Let me just repeat that. Well, this is the way he puts it. What to make of the rapid increase of the formal non-prudential from 2016? Is it in terms of credit only, i.e. digital platforms, or savings/insurance? You got that? Okay. Do you want to take those two, or should I add one more? Okay. Now this is interesting because I think it matches up to what Amrik has just said. Paris Mboro, who says ease of access through digital platforms by formal lenders has played a big role, and fair debt collection practices have put off many prospective borrowers. Aristachus Wero, from an aggregate on financial offering, it'll be interesting to hear the overall financial health comments rather than necessarily the financial inclusion conclusion. So overall financial health. So the panel again, if you want to take those ones.
Okay, yeah. My insights on that would be the increase in regulated prudential is I think a very, very critical aspect, and I think we alluded to it quite a bit, was the question of stability, the question of sometimes if you're dealing with unregulated sources, there's unfair debt shaming, probably. So I think regulation introduces, in addition to liquidity, the liquidity dimension that was mentioned by the person asking the question, I think there's the element of stability, there's the element of fairness, there's the element of certainty that also comes in there. On the rise of formal non-prudential, I think a very important element there is what we mentioned with respect to the portfolio, that people like a variety. So at some point you tend to probably exhaust your ability to take up and use the formal prudential to some degree, and so you want more variety. You get more utility and ability to meet daily needs from now extending to formal non-prudential, which still give you more stability compared to informal sources. Thank you.
Yeah, and just to mention that formal non-prudential is mainly driven by uptake of mobile money services like M-Pesa. And so I guess that often acts as an onboarding or a ramp into the use of more sophisticated, prudentially regulated services such as insurance and savings products provided by institutions like banks and others. So that would be perhaps a reason for that it's really, that's the first port of call, and then you get into more sophisticated use after that. Sometimes there are barriers, to taking up more formalized products, such as documentation-related barriers and so forth. But mobile money is accessible to many, many individuals and is very valued. Wallace, what was the question on financial health?
I need to find it. 1 second. Yeah, so what he was asking, well, I don't know that it's a question or a comment, but he says, from an aggregate on financial offering, it will be interesting to hear the overall financial health comments rather than financial inclusion conclusion. So in a sense, that nuance more to do with the financial health and this sort of aggregated. I hope Mr. Wero captured that correctly. I suspect that's where he's going to. So you and I, how?
Yeah, no, I think that's a very valid point, that we really should be interested in the outcomes or the impacts of finance as much as we are in the uptake of accounts. I mean, it's no use having an account if it's not adding value to your life. On the one hand, is it helping you to meet your financial needs? And on the other hand, is it creating outcomes for your financial well-being? So that's where we need to put a lot more attention, and that's not just down to uptake of accounts by individuals and households. It's also the role of finance in the wider economy that helps people to get jobs, that improves their well-being in many, many senses. So when we're looking at financial health, we have to look at the wider role of finance in the economy and not just financial inclusion. In terms of uptake of finance to meet needs, I think that's another area of interest here. People are tending to turn more to informal services or non-financial strategies to meet their needs. So the question here is, how can we make finance more relevant in helping people to address shocks, helping people to bridge their income shortfalls, their liquidity needs, and helping people to invest in the future, which is where we see the formal sector playing the strongest role, particularly through formal savings.
Okay, just checking in the room before we listen and hear from our principals. There's a lot of questions coming in, and of course the conversation will go on, but is there anyone in the room perhaps who wants to chime in or has a question, just so we don't skip anyone? So I'll just do, well, at least read out the final one, which is from Genga Kevin, who says, it's surprising that 23% of respondents cite inability to maintain accounts when no frills accounts exist. Is it a case of lack of awareness? I wish there were bankers in the room to tell us that, but interesting question. Is it a lack of awareness that is leading people to not have an ability to maintain accounts?
Again, I would put that perhaps down to liquidity, rather than lack of awareness. I mean, no frills accounts do still have costs associated with them. So I think that would be my response to that.
Okay, Professor Mdida?
Yeah, and then as economists, we always like to look at alternatives, opportunities, opportunity cost, and so on. So if there are other options that exist that are considered to be more viable or considered to help to meet those daily needs more easily, you don't need to maintain probably minimum balances and so on. People will go for other options that offer them greater utility for livelihood needs. Thank you.
Thank you very much, and like we said, the conversation will continue. For now, we want to hear our principals These are the heads of the three institutions. This is the Kenya National Bureau of Statistics, FSD Kenya, and the Central Bank. So I'll begin at this stage with inviting McDonald Obudo, MBS, who's the Director General of the Kenya National Bureau of Statistics. Mr. Obudo, welcome to the stage.
To our chief guest, the Principal Secretary, the National Treasury, Dr. Julius Moya, the CBK Governor, the Director, FSD, the CEO, IRA, all the Chief Executive Officers who are here today, all the development partners represented here, distinguished guests, ladies and gentlemen, good morning. Yeah, I'll be very brief just because I'm just meant to make some remarks. But to start off, I'm very much delighted to be here today to witness the launch of the 2021 FinAccess Household Survey report, which we have been working on as a team. And as we have heard from Professor Mudida, we have had, this is now the 6th one. And we have had these surveys all the way from 2006 when when the baseline survey was done. This, from the trends that you've seen, there has been a lot of consistency in what has been done so far. And I'm very happy that today we have another report that we are launching. This survey has been very consistent in measuring access, usage, quality, and impact of the financial inclusion landscape in Kenya. And so what you've seen is actually quite a trend that has been developed over a period of time, which then is able to help us get to see what is it that is working for us as a nation, which areas do we need to improve on, which areas are we okay on. But what I've noted from the whole report is that for all the good indicators, they're actually on the upward trend, which is really very, very important for us. And the bad indicators, like the exclusion, it is getting lower. I know at one point the COVID-19 really played some role to interfere with the good trend that we have been noting. Now, I also just want to mention that the Bureau of Statistics has actually been in very, very good collaboration with the Central Bank of Kenya, the FSD, and a number of other partners who have been of great assistance to this work that we have been doing. And this is something that we have been contributing in terms of financial resources and human resource requirements. And that goes deep into the technical issues that such kind of a survey would really require. This is a case that has actually worked very well over the long period of time that we have been undertaking this exercise. So we are actually very, very comfortable seeing this kind of results and ensuring that we provide what the government and the private sector, including researchers, that they can use to ensure that we have sound policies that would really be able to help us make our financial inclusion better as a nation. Financial Access Partnership has seen the generation of demand side data on the financial access and inclusion, including deep dive studies such as the SME tracker on impact on COVID-19 and on businesses. You know, for the earlier series, we are not talking of COVID-19, but we are flexible to the extent of ensuring that anything that is new, any factor that would really impact on the financial inclusion landscape are actually brought on board. And this is something, again, that has been well demonstrated. So, as has been said by the professor, there are those four key areas that we have been actually monitoring as our main objective of this study. And he has actually demonstrated by giving the figures that have come out of this research so that we see the trend for each of those major areas of interest, the 4 areas of interest. And it provides very good data and database for research. You have seen again what my colleague Rajab has shown here, which means that there is so much that we can still dig deep and mine that data further to give us what has not been printed or what has not been shared here. And that is a very good platform which really we need to embrace and ensure that we maximize on the information or the data that has been generated, because you know it is really expensive, very, very expensive to undertake a study. And when you do one, you want to have so much out of that. And you'd also want to relate what you are getting with a number of other studies that have been taken over a period of time. You know, when you talk of coherency of statistics, it allows you to bring on board what you've done here, what is there, and bring them together and get some of the indicators that might not ordinarily come out of studies if they are to stand on their own. So we are now in a very, very good space in terms of the richness of data that we are having over the last few years. Colleagues, it is worth noting that this exercise has been undertaken within the new frame that the Bureau has been developing, and that is the Kenya Household Master Sample Frame, which is developed from the 2019 Kenya Population and Housing Census. I know we have done the previous 5 other studies that we have done. We have actually undertaken them in different frames. For example, the first one, which we did in 2006, and 2006, and the next one was in 2009. They were actually done on NASEP 4, which was developed from the census of 1999. Then the next 3 were actually done in the frame for the NASEP 5. And today we are getting results of a study that is done in the new frame, which is the Kenya Household Master Sample Frame that is currently under development. And you can see from the trend that for all the 3 frames that we have used, the 3 statistical frames that we have used, the trends are clear. There are no unexpected spikes. So it tells you, again, the quality of the statistical frames that we have been developing. And that is a very, very important component. By the way, if you don't get that bit right, then your results will not make any sense, or they'll be very much deceiving. And that's why, from the Bureau of Statistics, it is our role to ensure that, first of all, census is done in a very competent manner by following all the scientific processes that are required. to meet the international requirements. And the next is to use what comes out of that process to develop the statistical frames which are now used for the subsequent surveys. And this is one of the surveys that is actually benefiting from the frame that is still under development. And so, as a Bureau of Statistics, we are really happy that we are making contribution, and very positive contribution, to our processes as a country. The other thing of interest to me is actually the fact that this survey is done using the CAPI system. That is the computer-aided personal interview, which also puts us in a very good position. As a nation, we have never had any challenge with ICT. And so again, we have gone ahead to demonstrate how good we can generate data using, through the CAPI approach. So the other thing that I would like to mention is actually just the commitment that the Bureau is making, that we continue to factor in our strategic plan the FinAccess surveys, because we require the indicators arising from this kind of engagement. Next is to continue supporting the survey in collaboration with the CBK, FSD, and any other stakeholders whom we are collaborating with or who would be coming in to support this process. And lastly, in terms of commitment, is to ensure that we conduct the FinAccess survey very regularly, as guided by the MOU that we have signed as a group of the 3 institutions. So as I conclude, because I was just meant to make a few remarks, I would really urge the country to utilize the survey report that we are launching today, and ensure that we go beyond what is just going to be shared with us and get deep into the kind of demonstration that was being done, and it is on our website, which you'll be able to access with a lot of ease. There are several other data sets that would be of importance to all of us, the universities, the researchers, the government, all the data users. There is so much that we can get there. And students should find a lot of interesting information to play around with what is available in our website. And of course, it is a website that I believe in a short while we'll be able to improve it to make it much, much better. Already it is usable, but we are promising to make sure that the access to that website is really much, much better and very friendly to all of us. But as it is today, I urge all of us to take interest and play around with what is there. You'll get it very, very useful. And I'm sure, Dr. Amrik, we have had discussions with you on this, and you've been very keen in this area. And I'm sure even when Rajab was demonstrating a few things here, you felt like coming over here and doing more. The wonderful lady has some good history in the Bureau. She happens to be the daughter of, that was the first director of statistics? Yes, her father was the first director of statistics at the Bureau of Statistics in Kenya here. So we have connection, and I'm proud to mention that. So, good. So being that today I'm the sitting DG, she's my daughter. Thank you. Good. Thank you so much. So now to conclude, colleagues, I would not stop before really thanking the technical team. They have done a lot of work. They have dedicated their time we kept on visiting them where they were working, and you'll realize that they were giving it their all to ensure that this report comes out in good time. It is not long ago when we were launching the training of the survey. It is not long ago when data was being collected. And today we are talking of results. Thank you so much for your work, the good work that you've been doing as a team. Otherwise, I would like to leave at that point and thank all the collaborators and also thank our guest of honor for finding time to come and share with us and grace this occasion. Thank you so much, and may God bless you.
Thank you very much, Mr. Budo. He didn't tell you, or at least he only hinted at the amount of work that went into this. I remember the number of times that people did not sleep, and a few of the people who are responsible for that are here, literally working overnight to make sense of all that data. So thank you very much, Mr. Budo. That is the Director General of the Kenya National Bureau of Statistics. I'd now like to introduce and welcome Mr. Mara Cook, who's the Chief Executive of FSD Kenya, to come and speak to us and also make a presentation. Welcome, Tamara.
Good morning. It is an honor to be here. As I prepared I was asked to give some reflections on the numbers. And I think it's interesting to reflect on the numbers. I've been sitting next to the PS who's been furiously scribbling, looking at the report, doing his own calculations, and that's exactly what we want to encourage all of you to do. So I'm waiting to get the clicker so that I can go through. But let me begin by saying that the Deputy Governor started us off well. She ended her opening remarks with a series of questions, and I'm going to continue in that same vein by asking some more questions. I had the privilege of looking at this data before many of you, and so I dug into it, and I was asking, what about that number? What does that mean? And so today I'd ask you to join me in asking some of these questions. So let's see if this works. Great. So first, where do the FinAccess numbers come from? The Director General has just told us about the team that has worked tirelessly to generate these numbers. And it's easy to get excited about the charts and the tables and the datas, but this is where they came from. I had the honor of shadowing some of the enumerators in Kajiado County and getting to see firsthand what it's like to find the household, to select the participant who will be the respondent for the particular survey, to see the CAPI in use as it geolocated the household and as it went through the survey and captured the data in real time. It's difficult work. In this picture, you can also see my colleague Lukanya, who leads a lot of the work on FinAccess from the FSD Kenya team. And it's really about understanding what are people saying and what does it mean. And so I'd like to say thank you again to all who contributed. The Director General just thanked all of us, everyone who's spoken has thought, but I think it's important that we don't forget the 22,000 households who gave their time to answer what are many questions, actually. It takes a couple of hours to go through this survey, which is why this data is so rich and valuable to us. To thank the enumerators, the translators, the supervisors. In the bottom corner, you can see an enumerator with her translator, with my colleague, and of course someone from CBK. And the top right, you can see not only myself, but also someone from Capital Markets Authority. It's really great that this year in the FinAccess partnership, the rest of the financial regulators have been an active part of designing the survey and analyzing it and what the meaning is for policymaking in all sectors of the financial sector, all the different regulators. We're also pleased to have several Alliance for Financial Inclusion, which the Deputy Governor mentioned this morning as a supporter, but also several private sector players such as Equity Bank, Safaricom, and Postbank. So my next question that I'd like you to consider with me is, does access to finance provide value? In this respondent's interview, she was dutifully answering the questions, and every time they asked her about a new financial service, so do you use this one? She said, I have no money. Why would I use that? And this corona thing has made things worse. And so she would continue to answer the questions. She did use mobile money, but when they asked about, for example, do you have a bank account? She said, it's a 3-day walk to the nearest bank branch. Why would I have a bank account? And so it's that costs that we're talking about. It may be that the account itself doesn't have a lot of a cost, but the costs to reach it are high. And I think that it's important for us to understand that. And so is physical access to financial, financial access points still a barrier? In Kenya, we have come a long way. If I consider when I first came to Kenya in 2003, there was no such thing as a mobile money agent, no such thing as a bank agent. Branches were frankly few and far between. So we have come a long way. But if you look at this data from Kajiado County, which I decided to double click into, inspired by the data visualizations that are possible, you can see that the distance to financial access points in Kajiado County are far. Now, 46% of people are close enough to walk to a bank agent, but only 25% are close enough to walk to a bank. And so what does that mean for how valuable a banking service can be? I'll click to the next slide and ask my next question, which is, do customers understand the financial services they use? Prof showed this chart earlier, but I want to bring a story to it. In this picture, you can see the woman who's looking at that tablet, and she's reading out the SMS that is typical to receive in a mobile money thing. In this case, the woman was able to read it, but she was not able to interpret it. She didn't really understand what it meant. And so it's important for us to recognize that there is a significant gender gap in those who can read, those who can understand. And I think this chart, which Prof showed us earlier, really shows us, we may have come down to a 4.2% gender gap in formal financial inclusion, but the ability to read and understand a text is 10% gap. And it's even higher if you consider the 18% of women who can't read the text at all. So one of the questions this makes me think of is, what are the opportunities for reaching them with financial services they understand? How can we use digital tools, for example, like smartphones, to visualize the understanding of the products that are being offered? So my next question is, what role does level of education play in driving financial exclusion? We've looked at several of these FinAccess trend charts before, and in fact, I think Prof showed us this one as well. But if you look at those who have no education and those who only have primary education, the exclusion rates are incredibly high. And does the fact that they're unable to understand the services explain part of that exclusion? And what can we do? And if you were to double click on age and if you were to double click on gender, you would see that a large percentage of those excluded populations in the lower levels of education are more likely to be women and are more likely to be older. And so what does that mean for how do we reach older women? I think of programs like Inua Jamii, which has increased social protection payments for older populations, and that has actually increased their inclusion and hopefully also increased their understanding of what finance is and why it matters. So the next question I want to ask is, what is behind the access trends? In our team, we're not betting, I promise. It's good to see the betting numbers have gone down, but we asked ourselves, where's this number going to go? And there's some people on our team who actually wondered if it might go down. There were some who thought it might plateau and some who thought it might go up higher. For those of us who thought it'd be a bit higher than this, we asked ourselves, what's behind this? And how do we understand and make meaning of these FinAccess trends? But before I get to that, I want to ask, why does informal finance remain significant with growing formal inclusion? We saw in that chart above that the use of informal-only services has continued to decrease and now only at 4.7%. But if you look here, you can see that the use of informal financial services continues to be significant and in fact is growing. For example, in the use of chamas or friends and family or those are the two that are growing. But anyway, it's quite significant. So even those with formal access continue to use informal finance. What is informal finance providing that formal finance is not? What can we learn from the value that people take from informal finance that could be replicated or inspire new innovations in the formal financial sector? So back to the trends. One of the questions, and again, the prof talked about this, is how are the demographics changing, reflected in the access trends? Sorry guys, for some reason, mine is not keeping up with me. Just a second. So there's two demographic changes I'd like to point to. One is the sources of livelihoods. Interestingly, there are less people who consider agriculture to be their primary source of income. That has changed since 2019 pretty significantly. Now, if you were to ask them about all their sources of livelihood, which of course we did, agriculture would be higher. But those who consider primary has gone down. So has employment, so has business. The two that have increased between 2019 and 2021, and perhaps, we don't know, but perhaps there is a COVID implication here, is that casual labor has increased, which as we all know is not as reliable or certain as formal employment. And also those dependents have increased. So dependents are often those who are young and still getting support from their family, and those who are older. And we also saw that those are two of the areas that are more excluded. And then the growing youth population. I think this is incredibly important. We are very excited to have a growing youth population. There's a lot of opportunities. There's a youth dividend potentially. But what we're seeing is that between 2019 and 2021, 20% of the population was 18 to 25 in 2019. 28% of the population is in that age bracket in 2021. And with that group being more excluded, we need to ask ourselves, how can we bring more youth into the formal financial sector? How can we provide services that matter to them, give them economic opportunities to earn livelihoods where they want to bank their money? And those are some of the demographic trends that we see affecting these numbers. So I'd like to talk about gender for a minute. And how do we move to a gender gap? We share the excitement about the shrinking gap between men and women. But that shrinking gap is not good enough as we look to a zero gender gap. It also needs to be a gap in meaning. It needs to be a gap in the usefulness of those financial solutions. This picture is the same of the same respondent who I met and showed you earlier. But in this picture, you see her husband leaning over, trying to tell her what to say, as the enumerator is trying to get him out of the way. This enumerator was amazing and was able to, find polite ways to emphasize that it was she who was the respondent. But the reason he had walked over is he asked her about bank accounts. And she said, I don't have a bank account, it's too far away. But her husband walked over and said, well, I have a bank account, can you put that down? and of course, it targets households, but it picks one respondent in the household. So it's really about her access, which is what we're measuring. But you can see here that in Kajiado County, there is a significant difference between men who have a bank account and women who have a bank account, much larger than that 4.2% that we see for overall formal financial inclusion. And so that really drives us to the next question that I have, which is around financial needs. Forgive me, there's a lot of charts in here, some of which you've already seen, and I know you're all gonna dig deeper into them. But the question is, are financial services meeting the needs that people have? And we've already heard that the amount of people who have experienced a shock, so in that top left corner in the middle, has doubled between 2019 and 2021. Some of those shocks are a health crisis, a death of a loved one, but especially cost of living has really served as a shock for people, which has increased in the last year. The bottom left chart is a chart that always breaks my heart, and I'm so sad to see that it has gotten worse. We have more people going without food to eat, we have more people going without medicine, and we have more children sent home from school for lack of school fees. What is the role of the financial sector in enabling families to avoid these vulnerabilities? How can they generate more income and manage shocks? It's great to have IRA here. Insurance could be a part of that solution, right? About how do you not forego medicine when you need medical care, which is so very important. So there was a question earlier about financial health, and I'll confess, it's one of my obsessions. I'm always eager to see the financial health data. And there's a lot of data on this slide, but let me just give you some highlights. If you look at the difference between financially healthy adults in urban areas and rural areas are almost twice as financially healthy as rural areas. Men and women have a similar gap in financial health between that they do for formal financial inclusion of about 5%. The others are less surprising. If you have more education, you're more likely to be financially healthy. If you're wealthier, you're more likely to be financially healthy. If you have more stable income through formal employment or a business, you're more likely to be financially healthy. When we look at the ages, it's kind of interesting. You know, you're more likely to be financially healthy actually in that middle bracket, right? Where maybe your income is a bit more stable, you've gotten your education and you're developing. So I can't wait to dig more into these financial health metrics and look at what's driving this. What qualitative questions do we need to go out and ask so that we can find out more about what's driving financial health and what role finance can play in improving financial health. So does the use of finance promote financial health? This was a really interesting chart. So 38% of those who use traditional banks are financially healthy. That is more than double what the average is for the country. And so the question is it that financially healthy people use banks, or is it that banks are helping people become financially healthy? We don't know the answer to that question, but we would love to find out, and we'd love to explore questions like that with you. We also saw the graph earlier about the people using a portfolio of financial services. So very interesting to see that 21% of those who use more than one financial solution are financially healthy, whereas those who use only one financial solution are 4.2% financially healthy. And of course, those with none are very unlikely. I'd actually like to find out more about the 3.4% of people who are financially healthy and are excluded. I think we might have a lot to learn from them, actually. So sticking with kind of wealth, does the use of finance promote wealth, or is it just correlated? Each of these charts shows an upward trend. The richer you are, the more likely you are to use a formal financial service. Not necessarily a surprise, but how can we even out this so that there are appropriate financial solutions for every level of the wealth quintile? When I first moved to Kenya in 2003, there were many bankers who didn't believe that low-income households, poor people, farmers, micro-entrepreneurs were good business. And so there was a lot of work that's been done over the last years to show that they can be good business and that financial solutions can really matter in their life. But we don't have flat graphs here yet. And so how can we get these so that everyone has access to the same level of finance? Kind of sticking with the use of providers, why is it that mobile-enabled access is growing while other access is shrinking? You know, so bank accounts have continued to go up to 44%, but if you read that little call-out box, what you see is that mobile banking is really driving that, whereas traditional banking, what the prof called bricks and mortar, has actually shrunk between 2019 and 2021. Mobile money, it has continued to grow, and of course, Fuliza is now used by a higher percentage of people than SACCOs. And so how is behavior changing from cash to digital? The graph on the left was not presented earlier, but it comes from one of the slides that was presented earlier. And what is interesting is that between 2019 and 2021, people are daily using financial services more than they used to, in all categories. But on mobile money, they're using it twice as much as they did in 2019. COVID may have an impact there. Some of the measures taken by the government to encourage digital payments may have had an impact there, but very interesting. On the right-hand side, and sorry, it's a bit small, but what you can see is that people are using mobile money for more kinds of things. They're using pay bill and tills for more kinds of things than they used to. And while cash is still the highest, it is coming down as more people use digital. And we saw that combination of people who use cash and digital. And so I'd like to, I'm almost done. I'd like to consider two important categories of Kenya. The first is farmers. What does this mean for farmers? And in the report, you'll find lots of information around agriculture, livelihoods, and the meaning. But one thing that's true is that farmers face higher risks than many other categories of livelihoods, including pests and drought. And that little graph you can see on the bottom shows you that only 6% of farmers so far have adopted green practices for agriculture, even though they are bearing the brunt of climate change. And so what can we do as a financial sector to enable the greener adoption of smart agriculture solutions, climate-smart agricultural solutions that will help them mitigate risks, but also increase productivity and take care of Kenya at the same time? Farmers actually mirror the national average when it comes to formal financial inclusion at 83.7%. Interestingly, though, they're a little less excluded than the general population because they use more of these informal services. But when you look at that little tiny chart that's in green, what is the top sources of finance for farming? It's income reinvested, it's assistance from friends and family, and it's savings in a secret place. I don't have to underline that none of those are formal financial sector offerings. So what can the formal financial sector do to provide more valuable financial solutions to farmers who are feeding all of us? The second category I would like us to consider are enterprises. We've talked about micro, small, and medium enterprises, which are some of the highest included. But when we look at, again, what their top sources of finance are, they're reinvesting their profits, they're saving on a mobile device, so that's a formal financial sector, and they're getting assistance from friends and family. I'd also just like to take this opportunity to plug another one of the FinAccess suite of research, which is the MSE COVID-19 Tracker Survey, which we've been doing during COVID, looking at micro and small enterprises and how they're handling COVID. And I just pulled one chart out from the most recent wave, which was released last week. Around 55% of MSEs have now taken loans, which is up about 10% from earlier in the pandemic. And so is their business getting more secure? Are lenders finding ways to lend to micro and small enterprises in new ways? These are the questions that we want to consider together as we consider how we can really enable this backbone of our economy to create more jobs and increase their own incomes and sell us lots of goods and services, by the way. And this is my last question, and it's really to solicit your questions. We've already heard some great questions from the online audience, from those who are here. What are your questions? If you don't have time to read the whole report before the holidays, I understand we're about to close and some of you may already even be on leave. Check out the 4-pager. It's an infographic. You can dig into the highlights and then save the full report to January. Dig into those data visualizations that you were seeing, and let's consider together, how do we as a country in Kenya move from impressive FinAccess to meaningful Fin impact? Asantani sana.
A huge round of applause to Tamara. Tamara Cook is a Chief Executive Officer of FSD Kenya. Obviously, you've been hearing the three institutions over and over all through this morning, and you'll be seeing a lot more as you dig into the data. So just a very quick one. She did tell you about the 4-pager. There's also the full report. There's the visualizations. There's even the video that is being recorded right now as we speak, the live one. All this will be made available to you in very short order with all three institutions. So from the central bank, through our website and the other channels that you know about, FSD as well, and also KNBS, you'll be able to pick up all this material for you to be able to interact with and make sense of it. I now would like to invite, and again it gives me great pleasure and honor to invite the Governor of the Central Bank of Kenya, Dr. Patrick Njoroge.
Thank you very much, Wallace, and good morning, everybody, all of you who are in this room, and all of us, all those that are following this session online. I'm very pleased to be here to join you at the launch of the 2021 FinAccess Survey report, and of course the detailed data set from the survey that we've been told where it is. This concludes more than a year's worth of work by a diligent team of researchers. I think there was some sort of allusions there that we only did it from June. Actually, the preparation started much before. And it's amazing, when you prepare things well, things go quite smoothly. And I think this team has shown have proved that to distinction. So let me at the outset express my gratitude to all involved for an outstanding job. In particular, I want to recognize the Director General and staff of the Kenya National Bureau of Statistics McDonald, thank you very much for bringing your team. And they played a dual role of being the research house and, of course, as a funding partner. Thank you very much. We are also deeply indebted to Tamara Cook, CEO of the Financial Sector Deepening Trust, FSD, and her team, Amrik and others. Thank you very much for financial and analytical support offered during the entire survey process. Of course, I also want to recognize our very own central bank staff that have done an exceptional job as well, not surprising. And I'll just now under the, let's say, the leadership of Robert Mudida, but there's been others, you know, Tieno, Irene, a lot. Thank you very much for the work that you've done as a team. You know, I'm now speaking after significant presentations have been made. And I think we have just had a master class in financial inclusion, financial access. I think now I'm ready for a degree, you know, minimum, you know. So let's see how we can do that. And those of you that are watching online, I'm sure we can facilitate some sort of electronic degree, you know, maybe with a blockchain, something on it or something, I don't know. We'll find a way. But I make that point sort of to emphasize the importance of what we are doing today, right? The work that we are doing here emphasizes a key element that we are data-driven in with regard to policy. Data is so very important. Unfortunately, not everybody sees it that way. And I think we've proved it yet again, the importance of data. All those questions that were put forward, Robert, the DG before me, Tamara, there are many elements in here that really would lead to policy conclusions. So it isn't just the 82.7% that matters. There are many questions, and I think a lot of you have already seen it in this masterclass over the last 2 hours. Of course, the Kenya's transformative journey and leadership in financial inclusion is as undisputed as it is impressive. In the 15 short years since that first baseline survey, access to financial services has more than tripled, increasing from 26.7% in 2006 to 83.7% in 2021. As we have explained before, repeating the well-worn story in a million different ways, in a million different fora as well, this was driven by a confluence of 4 self-reinforcing elements: the spread of digital phone technology, expansion of agency banking, a supportive regulator, and a compelling use case that has a strong impact on society. These elements created a perfect storm that has led to the increase that we mentioned a moment ago. I'm gonna skip through a lot of what I had to say because virtually all of it has been spoken to. So I'll be a bit more, I'll do a bit of surgery to my remarks. But I think at the same time, we need to appreciate that these are no ordinary times. And I think the particular improvement in the survey that is recognized in the survey that we are launching today, the 2021 survey, relative to the others, has also been explained. It isn't just a matter of access. Most countries are still struggling, understanding what is their level of access and improving access. And I think from our perspective, we've actually moved to the other dimensions. So it isn't just a matter of access. As was mentioned, there's impact. As was mentioned, there's usage. And I forget the fourth dimension. quality. All these are key elements, and they're actually, they have significant policy directions as well. So I also think this survey has done significantly to highlight some of the conclusions that maybe we had priors about. For instance, things related to the use of technology. Technology has emerged as an equalizing catalyst to financial inclusion across the demographics. And I think there were many points that were raised in the presentations before me to illustrate this point. There's also the issue of informality of financial inclusion, which seems to be dissipating, the informality element. But of course, we also have the other thing on the quality of financial services. This is an element we need to look at a little more. The financial services, the quality of financial services. Issues of financial literacy, for instance, and consumer protection, transparency in pricing of financial products, resolving challenges, and concerns about household indebtedness are becoming topical. And those are highlighted in the survey results that you can actually drill down, as was mentioned by Rajab and others. Now, having said all this, of course, we do also appreciate the timing of this survey. It was done during the COVID period. That has two significant elements. The first, of course, is our, I guess, the numerators or enumerators, the people that were doing the survey. They were actually, it wasn't business as usual. I did like the photos that Tamara showed us, and all of them masked and in all sorts of places. So the conditions were not exactly the most hospitable because of the COVID situation. But yet, we decided to go ahead with it and not delay it a year or two, because there are important data that could come, particularly during this time. The second, of course, is how were the people coping with COVID? And I think some of the elements here, for instance, the dependency ratio, which Tamara talked about, particularly of the younger people and also the older people. These are things that maybe we would have glossed over if we were actually surveying, if we have initiated this survey during a more normal year. So I think there are some elements there that, some important data points, as it were, or important conclusions, which will lead to, let's say, policy action, etc. I'm delighted that obviously the PS is here soaking it all in, because later on I think a lot of the work will end up being in his office, but that's okay. We'll work on this together, PS. One of the elements that is a problem, and we need to research this a little more, is that the exclusion rate remains stubbornly high. It is 11%, 11 point something percent, I think. And it hasn't come down as much as maybe we had expected. So what's going on there? And I think some of the slides that were presented, Tamara and Robert, gave us an inkling as to what may be going on. It may be, first and foremost, the things related to where the economy was during the COVID time. So people didn't have income, some people didn't have income. Maybe the youth were more dependent, or still in their mother's house, instead of out there working. All other things related to women, right? So women possibly didn't have direct access to financial services, but rather have access to financial services through the husband, as was pointed out by your anecdote, Tamara. So there are many things there that I think we can look at and begin to figure out as policymakers what exactly, how can we, let's say, deal with this problem directly instead of having a sort of a generic, broad brush approach to to the problem and hoping that the problem goes away by itself. So I think there are many, many, many points. So I hope you'd agree that the team that worked on this survey has done a fantastic job. We are obviously happy because they are wonderful people, as we know. By the way, I was very impressed that Tamara, not today, but before, Tamara actually went to Kajiado and actually spent some time figuring out how this thing is being done. I was actually, at one point, I kidded her and said, well, the problem with you going there is that you kind of tilt the results, you know. And she explained to me that that wasn't the case, and I took her argument. But I think the point here is that there was a lot of quality work that was done, supported, of course, by others. The Alliance for Financial Inclusion, AFI, we are members of that, and delighted that our Deputy Governor serves on the board of that institution. The SASRA, and thank you very much for including, coming in to understand and help us in various ways. Equity Bank, the Capital Markets Authority, IRA, the Retirement Benefits Authority, KDSC, Safaricom, Kenya Post Office Savings Bank, Muungano Microfinance Bank. All these have been there supporting us in this survey, both financially and also in terms of encouraging us, particularly because they understand the benefits from the survey. So their financial material support enabled us to successfully carry out this survey. So please accept our sincere appreciation. We invite other partners on board, as there are still a lot of research opportunities to break into new ground that requires your financial and material support. And in this, I want to tell a story. When we started off this survey, maybe it was, I don't remember then when it was, maybe 2 years ago even. It's way back then. And we tried to get some of the development partners that we thought would be around, would be interested in seeing the progress of Kenya in this space, to come and support us and join us. You can go farther when you go with others, you know. And some of them were a bit reluctant. And their point was, you know, Kenya is so far ahead in terms of financial inclusion. So why should we spend our money on Kenya? Why don't we spend our money on another country doing, let's say, surveys, a country that is farther behind in terms of the numbers? And my argument, unfortunately, did not win the day for most of them, but some of them actually understood this. And I continue to repeat this to them and to you, which is Kenya is ahead. It is the car that is ahead, meaning we are the ones that are opening the way for everyone else. So it's therefore that much more important for us to understand what is possible and what is holding us back. That has significant benefits, not just to us in Kenya, it's to everybody in the East African community, to everybody in Africa, and to everybody in the world. I'll give you a simple example. We've all heard of the Grameen Bank. Grameen Bank in Bangladesh, started by, I guess his name is Yunus, and actually it was very successful. And that lesson has been replicated around the world, at least in that demographic. It's true, they did get a Nobel Prize. I don't remember when. I doubt we will receive a Nobel Prize for this. The other problems, the Nobel Prize, which we can discuss elsewhere. But I don't think we'll get Nobel Prizes for data, you know, or cooperation, etc. But what we are clear about, we are not here to win those prizes. We are here to understand and again deal with the issues of our population. It is really a matter of the livelihoods of people. And if we can affect that, I think we'll be okay. So I'm delighted we are here. I'm delighted that there'll be a lot of work that will be done with the data set that will be freely available. I challenge all of you to begin looking at it. The journalists among us, well, you can write a better article with more data. You go in there and slice and dice the data. Don't just begin with 82.7, as Wallace said. There's a lot more information back there. But I think there is information that can be used at all levels. I want to just underscore the innovativeness of the Tableau Public. I don't know why it's called that, but that's the the facility or the platform that you're using, and I think in some sense it shows the importance of data, where we hold data. So thank you again, and I encourage all of you to go there. So before we launch this, I think it is my distinct honor to invite the PS, but before I invite him, I want to say that, yes, he is one of the persons that we feel very close to, because he has the same, let's say, approaches as ourselves, meaning the importance of data. He holds that dear. More than that, he was one of the persons that was involved in the Vision 2030. PS, you could tell us why in Vision 2030 you missed out on the a sort of a target on financial inclusion. But maybe you shouldn't tell us about that. We can talk about it at a later point. But I'm pretty sure there'll be a lot of occasion for us to discuss this going forward. So thank you very much. And PS, you have the floor. Thank you very much.
Thank you. I intend to speak without the mask so that I can be audible, and sincerely appreciate the opportunity to speak to you this morning. Governor, Central Bank, my friend McDonald from KNBS, Tamara, thank you. Good people, I recognize all my colleagues from government. I recognize everyone who is involved in this process, and even those who are participating online. It is my pleasure to say a few things before we launch this very, very exciting survey report. And so, you know, listening to the speeches that have been made before me, and also reflecting back on what has happened in terms of getting us to where we are, I want to congratulate the institutions that were involved: Central Bank, Kenya National Bureau of Statistics, FSD, and also the regulatory authorities in government that were involved, because this was invoking SDG number 17 in terms of collaboration, in terms of partnership, in terms of doing things together. And so this is a step in the right direction, and I do sincerely congratulate you for working together, because together we'll go very far. I want also to echo what Governor has just said about my belief about data, statistics, and how they enable us to be better decision makers. Because as you can see, for KNBS, if you look at the bottom there about their mission, they point out as evidence-based decisions. And it is data that is supporting decisions which will make you a better decision maker. So as we go through the process of collecting data, analyzing it, it will enable us to see the truths and some hidden myths that sometimes without having that capacity to analyze and look at data, you'll miss it. And so for us in government, in the policy space, this is very useful for our policy making, very useful for the programs that we design, and also very useful for projects, for action plans that we develop, and also now speaking from the National Treasury point of view, in terms of resource allocation, this is indeed very important. Of course, it enables us to measure and come up with a monitoring and evaluation framework so that we can be able to gauge where we are and how well we are doing. Now, Tamara has asked so many questions. And you know, I was writing them down. At some point I said, no, I can't keep up. But I think that is an indication of the wealth of information and potential information in the data set that has been presented. And one can look at it from all different angles, the angle of access, as has been indicated, the angle of usage, the angle of quality, the angle of impact, and many other angles that we can bring in. And I want to add the questions that Tamara has asked, so that we can also ask ourselves, what else can we get? Because sometimes, you know, I see scholars struggling to find areas to study. And here we've got so many potential areas where one can study. For instance, just looking at the youth, this group of people between 18 and 25 years of age. I was lucky to have these reports with me, and so I was able to look through very quickly. And on page, I think page 23, no, page 14, I mean, very surprising that this group, which Tamara, you have indicated, they are about 28% of the population. The percentage without IDs is a staggering 28%. Then I ask myself, if then this group does not have IDs, are they able then to access some of the services that we need for inclusion? And that is actually something that we can dig in for purposes of getting more information, doing more analysis. But why don't they have IDs? And why are they using other people's identities so that they can have financial access? I think the questions that are behind what we have seen, they provide a fertile ground for more research to give us better information that we can then use for policy direction, policy interventions, so that we can achieve that which we have planned to achieve. Obviously, bigger things like what then if you are to quantify, and I believe using the clever maths that Prof. Mudida has and the people who are doing the analysis, you can actually do some attribution in terms of what is the attribution of urbanization to an inclusion or exclusion, what is the attribution of age, what is the attribution of education, and so many other things, so that then as we are planning in our interventions, then we have got the attributions that we can quantify mathematically and be able then to structure good policies and good interventions. But what actually was also surprising to me, but not very surprising, is the finding that money is still, or cash for that matter, is still the king. I did a quick, rough average. And if you look at the usage of cash, it is about 60% or so. It's dominant. Now, is that a good thing? Is that a bad thing? But why do then people choose to use cash? And especially on daily expenses, where the percentage was 81%, and also medical treatment, which was 75 or 78%. Is there something that we can do? And this is where then we call the regulators who are here, so that we sit back and ask ourselves, what are we seeing from this data? And there's a lot that we can pick out in this respect. where we can get more information and move forward in terms of providing solutions. But let me go to something that I really do enjoy. And having a nice report like this and the data set that is there in the internet is to ask ourselves, then how shall we then disseminate this information? And I want to ask that question again. How do we structure our dissemination? And I like to approach this using some metric of some sort in terms of stakeholder analysis. And I would ask myself, if we were to think about some of the target groups that would like to make maximum use of this data. At the moment in government, we are doing medium-term plan 4. We were yesterday in a meeting where the steering committee launched the planning for medium-term plan 4. And I would think one of the big engagements that we can have on this FinAccess Household Survey report is the Ministry of Planning, or rather State Department for Planning, which is championing and which is providing leadership on the drafting of the medium-term plan 4 for the government. Also, at the same time, I would also suggest we also engage development partners. I know, Governor, you have said Kenya is way ahead. And indeed, in terms of access, Kenya is way ahead. I had a chance to look at this report, and I saw on page 23 that at 84% almost, Seychelles is ahead of us at 95%, South Africa ahead of us at 90%. And then we ask ourselves, is there then room for us to engage development partners as we are designing programs with them, so that the reality of where we are in Kenya can be taken in, and we design programs that resonate with the level where we are and also address the areas where we have gaps. We also have the financial sector, and you can think about insurance, we can think about the banking sector. I mean, how shall we engage with that sector in a structured manner? Is it through the business member organizations? Is it KEPSA? Is it Kenya Bankers Association? Let us think about a very structured way of engaging with the banking sector, and also the private sector for that matter, because there are opportunities for the private sector, which are implied here. My last one in terms of dissemination groups, and Professor Modida will hopefully agree with me, is we have very many academicians, including students who are doing economics. It could be pure economics, it could be economics with business and whatever. The last time that I looked at the statistics, we had in Kenya universities about 25,000 students doing economics degree. It could be economics, pure economics with statistics or something. And this would be a good target for us to share this FinAccess Household Survey, including their professors. And so I think an engagement with that group would be very useful, because we'll be planting the reality of what we have in Kenya in their minds, so that as they are going through their studies and as the professors are structuring research projects, there is a reality, and it is something that is domestic, it is something that is local, it is something that is useful. So the dissemination bit is big. I also want to encourage in the new year a dissemination to National Treasury specifically, because there are areas where this would mean a lot for us as we structure the budgets for the country, and also as we look at programs that are being proposed by various ministries to support wealth creation, reduction of poverty, and many other things that we see the access can help us in terms of interventions. And so for me, I am really very excited about what has been presented, to thank the institutions that have come together and encourage us as we think about the next study. Let us think more also in addition to finding the reasons behind the profiles that we are getting. Like I've said, why are those youths not taking IDs? Why is there such preference for cash instead of other modes of payment, and so on and so forth? So for me, is to encourage all of us and commit that the National Treasury is going to be available to do that which we are supposed to do, to support studies like this, to use studies like this, and also in that ecosystem of encouraging evidence-based decision-making, we want to commit that we will rely more on data that is drawn through proper evidence. I want to thank you for inviting me to come and represent my cabinet secretary and communicate that he was not able to come and be with us, but then he sent his congratulations for the team that has been working on these survey reports, and he said that I convey his support for the work that we do. That is what I would like to say, and so that then we go to the next point. I want to be guided by Wallace. What is the next step, Wallace?
A very, very big round of applause to the PS. I suspect PS, the next step is the one you've just said, which is dissemination. Umetupatia kazi nyingi sana, because we have to get this out to everyone. I want to ask Dr. Isaac Mwangi, who was the overall coordinator of this. Isaac, tufanye kazi.